Hello and welcome to the latest Retire Well episode. As always, you're joined by me, Matthew, and I'm joined by Joe. Today we're going to talk a little bit about how we help clients to phase into retirement and how this can help manage the psychological and the financial journey from working into retired life. So traditionally, when we're talking to clients, for some people, retirement is almost a scary thought, and therefore phasing into it can manage that sort of scary transition and can manage the practical implications. And for other people, retirement is just a bit of a scary word that sounds like you're getting old. So I've had some clients who say to me, please don't call it retirement, please call it the next chapter. And I think with modern pensions and flexi drawdown and everything like that, it's all the different tools that we can use to help people in that transition.
Yeah, absolutely. As Matthew said, retirement has very much gone from, especially when DB pensions were much more common, and you could essentially work to your retirement age, be it 50, 60 or 65 potentially. You'd take your tax-free lump sum and then you'd take your scheme pension, which would essentially see you off for the rest of your life and potentially even give a dependence pension as well. Nowadays, now that they're not as common and flexible pensions, as Matthew said, are, people have the opportunity to look at a more flexible option, but some cases are maybe almost forced down that path if financially they're not able to fully retire. In researching for this podcast, I thought I'd have a look at sort of what percentage of the population were looking at it, and there was some research by Legal and General a couple of years ago that said almost 50% of employees over the age of 55 are at least considering a phased or partial retirement. So as Matthew said, we're going to look through that today and hopefully give you some sort of thinking points on whether it's right for you and what you need to do to get there.
Definitely. One of the big employers close to us, Caterpillar, they've got a really good wind down scheme where essentially when someone's approaching being ready to finish, they can hand in their notice, and essentially over an 18-month period, both them and the company are getting prepared for that retirement, and they start to drop a day and then drop another day, and that's perfect for the individual for being ready and getting used to what retirement looks like, but it's also perfect for the company because they're starting to have that knowledge transfer and making sure that when someone's not there on a Friday, someone else is doing their job, and it's encouraging both parties to work together. Again, not every firm offers it, not many firms offer it, but actually a DIY version of phasing into retirement can be a perfect way to sort of manage the why, so why you want to get into retirement, and also the practical implications of, okay, how does your routine change? How does your identity change? And most importantly, when we're talking to clients, financially, can they afford it? What does that look like? And for us, that's a really good place for us to work through that journey with clients.
Yeah, I think Caterpillar are one of sort of the big employers here in the Northeast, and they do it really well, especially when you're looking at a couple of the big problems when you get to retirement, almost on the softer side as opposed to the financial side, the sort of maintaining purpose and social interaction that some people initially struggle with until they get into their sort of new regime and sort of easing into that lifestyle shift. They essentially do it over a 6-month period where you drop one day and then after 3 months you'll drop another day. And we've only heard good things from the employees there about how it really just helps slide into retirement a bit easier as opposed to sort of just jumping straight in off the diving board. But on the flip side of that, if you're looking at sort of phasing into retirement, it doesn't just have to be that short-term 6-month period. We have clients where it might be 5 or even 10 years of dropping days, reducing your income levels, and I think that's where it almost flips around. You do have the softer behavioural stuff, but then that's when you can almost look at the hard finances of, if you're not ready to work until your state pension, how can you start dropping days and how can you phase into retirement successfully?
Definitely. I think when we are talking to people who are planning for retirement, some people could go, okay, I want to finish as fast as possible because I want to be retired, I want to sit on a beach and I want to enjoy life. Actually, we find as people get closer and closer to retirement, there can also be more of that friction and more of that, I'm not sure if I'm ready. And that can be because of the likes of the social interactions, that can be I still feel like I've got value to add. And then also there's that financial bit, which we've covered in a previous episode, of how much is enough, and that scary idea that, when you're climbing the mountain, you're almost spending someone else's money when you're working, and the idea that when you're in retirement, you're then fully responsible for your income and you're almost managing that safety accumulation. So I think there's lots of reasons why people can see value in it. My own example for my mum, when me and my sister were talking to her about retirement, she was sort of saying, okay, I don't know if I'm ready. And the scary bits there would have been, the time, you're opening up more time, more flexibility, but equally you don't know exactly how you're going to fill that. And that can potentially be scary. You've also got purpose and identity. Again, often things like, teachers, they're known in an area, they get on with people, they have that relationship of talking to lots of people and they enjoy it. So again, giving up a role, that can be, quite a challenging thing. I've had a few clients recently who are engineers, who are really technical, really geeky, really love their job, and actually having regular conversations with them about when they plan to retire, but with I want to finish in 6 months, I want to finish in 6 months, and then it happens again, another 6 months. And really, it's because they're not ready, but equally society's telling them that they probably should think about retiring, so they're almost managing those external factors.
Yeah, I think there you focus really well on people that may either are scared or don't necessarily want to retire. Obviously, there is a percentage of the population that don't like the jobs quite as much and are wanting to get retired as soon as possible.
Yeah.
And I suppose that then you look at phased retirement as a decision, because yes, it's great, you could start dropping down your days sooner and at least experience some of your time off work, but there is an opportunity cost there. If you do start looking at sort of entering into a phased retirement, you're drawing on your income earlier, which could mean you might actually delay your sort of full retirement, I suppose, or maybe even sort of reduce down the amount of income that you take over the course of your lifetime. And I think that's where sort of looking at the cash flow planning side of things and look at, if we did this, what would happen? Or if we did that, how would that impact? I think can be really useful for people that are pretty sure they want to retire, but then they're trying to decide sort of how best to do it. Yeah,
definitely. And I think if you flip that the other way, you could have someone who really wants to retire, but hasn't built up enough to afford it, but they're at loggerheads to say, well, I really, really want to retire, but financially I can't. Partial retirement or change into another job that's less well paid and then supplementing that from a pension or an ISA or something like that can be the transition to say, okay, I can actually do this new job for an extra 5 years, but I'm working maybe half the hours or I'm doing something different so I can actually see myself doing that for longer. I think that's, like you say, the opportunity cost of, if someone says, what's their bucket list for retirement? You don't want to not tick those things off because either you haven't got enough money or because you've left it too late and you haven't got enough mobility or health to actually achieve them. So with all of these decisions, people are going with what's my top priorities, what are my assets, and how best can I make them work together. When we think about a phased retirement, one of the best bits to say is, okay, on a normal month, how much surplus income do you have as a household? If you've got enough surplus income that you could drop a day and that surplus income reduces but drops down to almost break even, then you're not even having to draw on any assets, you're just maybe not topping them up as much. And when we think about cash flow modelling and other things that we've talked about recently, again, they can be really good tools to say, what's your top objective, what you're looking to achieve, do you need to turn on income, or is it simply adjusting the expenditure as you go through?
Yeah, absolutely. I think it is a good time to look at those sort of practical considerations of we've made a decision, we're wanting to do it, how do we then do it? And I think what you've brought up there of sort of monitoring that income in sort of the year or a couple of years while you're making the decision can help you look at essentially what do we need to keep the lights on, but then, as you've said, what do we need to keep the lights on and also achieve all our retirement goals?
Yeah.
Because if you're just retiring and having rice and beans, you might want to sort of work for 5 more years and have a few more holidays abroad and enjoy it that way.
Yeah.
We always, when we're looking at retirement and even sort of non-retirees, we want to make sure that you've got an adequate emergency fund. And I suppose that's particularly important if you're looking at the retirement side of things, because stuff can change. You might want to make a couple of improvements here and there. I suppose general guidelines is sort of 6 to 12 months of income, so that can come as part of your sort of preparation of looking at how much you spend, and I think when most people when we sit down with them, they realise that their emergency fund actually can be much less than they might think it might be. Particularly if you've got flexible pensions and you've got ISAs and other savings that way, because although they take slightly longer than the bank account to get stuff out, most of them shouldn't take more than sort of 10 working days to get money from a pension into your bank account.
Definitely, and I think as well as thinking about the assets that you've got and when you're going to use them, you can also say, okay, what future income streams have I got? So again, if someone's got a rental income or a defined benefit pension to take in the future, and then a state pension, and then potentially a defined contribution pension which has flexi drawdown, in reality, you could be saying, well, I'm going to try and phase a retirement by turning on some of these different income taps. So I've had a client the other day who said, I'm ready to take some income, but actually instead of taking it from a pension, I'm going to sell a rental property, and I'm going to use that capital produced to tick off an objective such as changing the car, and then that will provide capital which they'll take almost to treat it as income for a year or two in retirement. That supplement in their other income streams almost is that phasing of one of the solutions, and it's just trying to say, okay, if I want to work 4 days a week rather than 5 days a week, what does that mean for the household income? What do I need? And then have I got a pension, an ISA, or other bits that I'm willing to dip into? The financial planners in us would say, don't take any taxable income from a pension until you're confident that you're retired, essentially, because of triggering the money purchase annual allowance and not being able to put large amounts back into a pension. But again, that comes with the journey of saying, between the conversation and when you're expecting to be fully retired, what's the variables, and is someone really going to put more than £10,000 into a pension in that year? Maybe not. Again, it's just making sure you don't do it too early, because if you then went back to full-time work, or if you had another project or something else came up, you might then kick yourself, like we've talked about on previous episodes.
Yeah, and I think sort of the amount or different amount of pots that you have to draw on or need to draw on depends on how early you're looking at retiring.
Yeah.
I mean, you've got the FIRE movement that's going on at the moment in some places online, where they're essentially putting everything in savings and then looking at retiring in sort of your 40s and really focusing that way.
So TikTok advice.
Yeah, exactly. But more practically, I actually speak to quite a couple of people that are coming up to retirement, maybe in the mid-40s, and they're looking at retiring. They go, well, I want to retire at age 55, because that's what everyone knows as the time that you can access your pensions. The issue there is that from 2028, your pension access age will go up to age 57. And if they've got their heart set on retiring at age 55, they've then got 2 years where they won't be able to access their pensions. Yeah. And that's when we almost need to look at other savings. It could be just investing almost a couple of years of income into ISAs, or, as Matthew said, potentially looking at rental properties or drawing down capital from there, just to get you over that sort of pension access line.
Definitely, and I think the other thing to think about is pension income isn't always linear for people. Again, we talk to people about income they'll need in their 80s. Is that going to match the income they'll need in their 50s and their 60s? Most people want the golden years of retirement. They want to spend more in the go years, so they want to front load retirement. So in these conversations, you're almost saying, as part of that phasing in, are you borrowing income from yourself in your 80s or your 90s, and you can model that on the cash flows that we've described to almost say, don't work too late and reduce the time you've got to enjoy yourself, but don't retire too early and spend too much of your pension funds. And I think that is almost the dilemma. We had a comment on a recent video to say, how can you plan because you don't know how much time you've got? Again, I think that's the crux of financial planning. You are planning to make sure you've got enough assets to see you through, but you're equally planning to make sure you've got enough time to enjoy those assets, and you're trying to have a safe accumulation to almost say, I've got enough, and also I can leave things where possible.
Yeah, absolutely. And then sort of almost building on the practical considerations of how and when, I suppose that then comes down to much more personal characteristics of what your income might drop to, because if it drops quite low and you might go down in sort of charity work where you're just volunteering, that's when you could look at sort of drawing up to your personal allowance. After that, you're going to be looking at, you can take tax-free lump sums out of your pension, and you could be taking them as regular income or sort of one-off payments. I think that's probably the almost go-to for a partial retirement if you've got a substantial amount of earnings, because otherwise you could potentially be drawn out of your pension at a 40% tax rate, which no one really wants. But it's just those sort of things of thinking, if you were to draw from your pension as taxable income, what are the alternatives? And most of the time we point to savings or potentially look at using tax-free cash from your pension.
Definitely, and the same way that if someone's got a defined benefit pension and a defined contribution pension that's a bit more flexible, they could say, well, why do I want to press the button to access my defined benefit pension early and potentially get hit by early retirement factors when I can bridge a gap with my flexible funds and therefore get the best value of both? So again, the boring answer in financial advice is everyone's circumstances are different, and you need to have your bits uniquely looked at to make sure it's right for you. But as you perfectly described there, what are the drivers for someone trying to phase? They're going to be very personal. What's the income sources? They're going to be very personal, and it's getting the two to pull together. I had a client the other day who, was quite happy to carry on working full time, but they've recently had a new grandchild, and they're seeing, okay, I might be asked to do some childcare. That might be 1 day a week. Again, the other side of the family might do another day. Then the parents might, be able to do a day or two between them. And that's where the family plan has changed to say partial retirement perfectly suits that person. Again, as the children grow up, maybe there's more needs, and that might be the time when they want to fully retire. But actually, in the same way, they want to maintain the routine, the work, the things that they've enjoyed doing. So they don't want to say, as of tomorrow, I'm fully finished and I'm sort of waiting around for the 1 day where I'm going to be providing the childcare.
Yeah, absolutely. I'm glad you mentioned around sort of DB pensions and whether or not to take them, because I mean, that's a conversation in themselves. Do you look at taking an early retirement factor to get your DB pension earlier, or do you sort of leave it? One of the really good things about some of the big public sector DB schemes like NHS and teachers' pension is that a lot of them actually offer and encourage a phased retirement. So with the teachers' pension scheme, if you drop your income down by 20%, you can take up to 75% of your teacher's pension to help sort of facilitate that move into retirement. NHS, which we're going to cover sort of in a little bit more detail on a future podcast, they do retire in return, where you can look at essentially taking some of your DB income to essentially facilitate a drop in days or fully retire and then come back. So I think those are really interesting ones. And again, that does come down to sort of the personal nature of financial advice. But speak to your employers, speak to the pension providers, especially if you're in the big public DB schemes, to see if something like that is an option. Because I know when sort of talking to a number of people that they don't always know that it's there and they don't know it's an option.
I think that's a very valid point to make an informed decision. You want to know what your options are, and then you can work out what's best for you. I think, the majority of our clients who start talking about dropping a day and phased retirement, most of them it will be so can I take some tax-free cash so I can top up my income? So I think that's the most common one to say, how much is enough? Well, I've got enough that I think I can afford to retire now. And actually, maybe I'm not psychologically ready, so I'm going to use some of that. Therefore, my financial picture will be better. But in using some of that tax-free cash, I'm still maintaining the flow and the balance between income and expenditure. And then potentially they then say, I'll drop another day, I'll turn that income up a little bit more before settling on my future long-term income. And as we described, that can almost delay using other sources or other assets. Again, very personal to the individual at that point.
Yeah, and I suppose it's probably a good time actually to not pump the brakes, but talk about some of the potential pitfalls of a phased retirement. The main one for me that pops up that a lot of people don't think about is potential national insurance contributions. So for a full state pension, which currently is at 11,973, had to double check there because it's just changed in April. I almost said the last year's.
I'd just say nearly 12,000.
Yeah, nearly 12,000. But yeah, to get the full state pension, you need the full 35 years. And obviously, if you're retiring early, you might not have contributed your full 35 years yet. And there's a number of different ways that you can do that to top up. The best way to start off with is to look on the government gateway to check how much you have contributed. And then after that, I suppose you need to look at the options of potentially backfilling some years. If you've dropped down to a part-time and you're below a certain income level, you might have to do a sort of partial top-up to get that national insurance year. Yeah. Matthew, do you have any other ways that you could look at sort of topping up NI?
Well, so I think as long as someone's not dropping too many days or too many hours, and they're not dropping below that threshold, they should be okay. But in general, when they look back, that's where adult childcare credits can be a good one. Essentially, if someone looks after a grandchild and the parents are working, you're able to claim the NI credit for that. And anyone who's been looking after people, attendance allowance, other things like that, there's the ability to claim. So I think you just want to make sure that you've got the full allowance available, state pension wise. And as you say, the pullback is almost just to go, just double check you're not doing it too early, because the emotional bit can be, I want to retire as soon as I can. But sometimes people have built a longer term plan when they've said, I'm going to retire at this point when I expect to finish my mortgage and other things. If I pull retirement forward and have a partial retirement a few years early, say 3 or 4 years early, is there an element there of, I need to then take a lump sum from a pension or more income from a pension to service the mortgage? And are you then potentially compromising that income stream? So you don't want to go too early and then potentially have to get another job in your late 70s or 80s. But you might go, oh, well, once I've got to more than enough, then I'm happy to put the plan in action.
Yeah, just to touch on the sort of the child credits for childcare, I think that's an interesting one that not many people are aware of.
Yeah.
And if they are, they might not know how or what you need to do to claim. I mean, I was speaking to a client just last week, and she and her husband have just had their first child, and they're well above that sort of 80,000 income level, which means they don't have any child benefit, or well, they can, but what they would get, they have to 100% repay. For any NI credits to be available, that you do have to still have that child benefit in place. Okay. Otherwise, you can't access it. So even if you're not necessarily going to benefit from child benefit yourself in a monetary term, speak to your mum and dad that might be looking at a retirement and see if they could potentially benefit from that credit. So yeah. I think that's one, again, to look at and just see. It might still be worth claiming even if you are over certain tax thresholds.
Yeah, definitely. And one of my friends actually said, his parents had said to him, oh, is it okay if we use this credit, you've got from your child so that we can top up our national insurance? My friend to be said, am I being scammed by my parents here? Are they taking something from me? Again, when I looked at the numbers, it was essentially a free benefit for the grandparent in exchange for that childcare that they were providing. So for me, it was a no-brainer. But you're right, the spidey senses for some people come up to say, is it too good to be true? Am I missing something?
It's probably worth saying that only one person can claim the credit. Yeah. So in your friend's case there, if the grandparents had claimed it, but the husband or the wife were not working, then they're losing out. So.
Yeah, they were both at work, so there was no one to lose out. It was a sort of a free credit. But yeah, I think it's those sometimes those loopholes, those edge cases, and I think I read a study that lots of people who were eligible simply weren't claiming because it wasn't a well publicised sort of area of options available, and I think it's not very catchy. I think it possibly needs a catchier name.
Yeah, exactly. The only other sort of, I suppose, thing that I want to touch on today about potential downsides of a partial retirement is potentially look at the knock-on effects of what might happen if you drop a day down and reduce your salary. I mean, a lot of employers now give benefits that are based on a percentage or a multiple of salary. So most of them will look at sort of a death in service. It might be 2 times or 4 times your salary. And death in service is essentially just like a life insurance. If you drop your way down, then you're going to get less. For most people, it is just seen as sort of an added nicety to have, but some people might have looked at that death in service as something that could pay off a mortgage if they were to pass away. So just another thing to look at. And then I suppose, again, another one, and probably not as impactful if you're looking at retiring, but you might get a reduced holiday entitlement with your employer. But I mean, weighing up between retiring and losing a bit of holiday, I know which one I'd do.
Yeah, I think the death benefits is a very valid point, because especially if someone's had some ill health, that might be an incredibly valuable benefit. And the idea of reducing might be perfect for the individual, but they might not have quite thought about an extra gap that they're creating. And equally, their pension contributions would reduce. Again, that's linked to salary. So if you've planned something to retire at, say, 60, and someone wanted to go at 57, again, they might have to almost factor in what they would have saved between 57 and 60, or again, what's the reduced contributions going in. So there's lots of moving parts, and the boring answer is, if this is something that you're looking at, look at your circumstances, look under the bonnet of your individual pensions, investments, and get good financial advice to help push you in the right direction. We talk to our clients, and we're sometimes saying, actually, it's a bit early for your plan, you should be carrying on working. And sometimes we're saying to people who are planning to work for longer, actually, you could go early if you want to. How does it work for you? So I think that's where financial advice can really help. And then by planning a few years away, you can also manage the psychological bits, which I think aren't really talked about as much as they should be, because retirement is psychological and financial, and it's about getting excited for the next chapter, coming up with a bucket list, coming up with a plan. And one thing that we haven't really mentioned specifically here is it might be a joint plan, husband and wife. It might be one's going to retire earlier because of an age, but then it might be, well, if actually at the same time someone then phases in, and we can then be enjoying bits of our retirement together. So I think that can be quite a valuable way of looking at it as well.
Yeah, absolutely. I mean, I'm happy with what we've covered there. I do have a couple of questions which I think would be good to debate. One of which we've already kind of answered within the current episode. Yeah. But I've seen it on a few different videos that we've put out. Is sort of, can I contribute to my pensions if I move part time? What are the potential limitations, Matthew?
Yep. So you can still contribute. You can still contribute essentially up to 100% of your salary. So as we said before, if someone's reducing their salary, it might have implications of how much the employer is going to put in, but you could still put in money yourself as well. The key bit I would flag, as always, is that money purchase annual allowance. If someone takes a penny worth of taxable income, they're reducing their potential pension savings from £60,000 down to £10,000. Again, as you're getting closer to retirement, most people would say that doesn't really matter too much, but actually business owners or other people like that potentially have the ability to put large contributions in.
Yeah, great. And the other one that I had, I suppose, a little bit more of a specific scenario, but I thought it was really good in sort of highlighting potential opportunities for a partial retirement. So this was a comment about potentially having the offer of taking their DB pension at age 57 or 58 and moving into a part-time week of 21 hours a week, with the option of then, instead of paying into your DB pension, you'd be paying into a new DC pension for a few years. And they were essentially asking, is that something that would be good, with the presumption of the employer wanting to move away from the DB? What are your thoughts on, Matthew, and any additional thoughts?
So I think in that scenario, the individual saying, I've got an option to use my DB pension and then have that as an income and then save more into the defined contribution pension. I think that can work perfectly if the numbers work, but equally you could flip it the other way and say, is there the ability to use some of a flexible pension to then delay taking my defined benefit pension, or potentially to save more into the defined benefit pension, which we know are really valuable pensions. So sometimes if the employers are encouraging it, there's something in it for them. Again, that comment there says they want people out of the scheme. So maybe it's a case of actually that might be the most valuable years for them to stay in the DB scheme, and they should think about a plan B or plan C. if there's no other options, then certainly turning on a taxable income source and then saving back into another pot, can work for them.
Yeah, I think it's pretty much what you said at the end there. Some employers will mandate that you have to move out of a DB scheme, and therefore the case of sort of dropping your hours to 21 a week and sort of paying into a DC scheme, it's not really a choice there, you're going to have to do it. I think if it's not a mandated thing where you have to move away from the DB scheme, as we've talked about throughout the podcast, they're really powerful pensions, and a lot of them are based on your final salary or your career average close to the end of your time in the scheme. So it's one to think about, and again, this is probably one where we would say look and speak to a financial advisor and sit down, understand what your options are there.
There's a couple of schemes I've seen as well that get to say 60 as a normal retirement age and then don't have a late retirement factor. So I've had some people in the past where you go, well, the plan was to work to 62, but from 60 I'm getting no benefit from this pension and not taking it, in which case pressing the button, starting that pension seems logical, and with that income produced, if it's not needed, in the same way as that question, it could almost be used to put more money into pensions, more money into ISAs, and you could start to almost recharge other investment vehicles. So it's just what works in the scenario. Don't simply do something because you're planning to work for longer or you plan to go early. It's like having that double check, that sense check of, am I doing the right thing for me right now, but equally for the future based on accrual, saving, and then what you intend to draw down.
Yeah, absolutely. If anyone does have any more questions or scenarios like this, I think they are really useful in almost bringing the episodes to life a little bit more, to almost look at individual circumstances. And although we can't give advice, we can always just talk it through and give different bits of perspective. Do you have anything else to add, Matthew, or you're happy with
No, I think we've covered everything well. I think, my key takeaway would be lots of people value phased retirement because it manages the transition from a career into a next chapter. So I think a phased retirement can be the perfect way of managing the psychology of it and also getting used to where a future income source could be. So yeah, like you described, checking options, checking the technical bits of pensions, and then talking to someone like a financial planner to really work through that can definitely add value. As always, if anyone's got any questions or anything they'd like us to cover, please leave them in the comments below. And if you could share this episode with a friend, we'd really appreciate that. Thank you very much.
Thanks.